In terms of comparison to others, it's a much easier thing because India really does stand out. Not only is our growth higher, but we also seem to be at the start of this cycle because for the last 2 years, many parts of the economy have done badly, like capital goods and real estate and infra and all that. And the government's effort in the last 2 years finally seems to be converting into businessman seeing an order and seeing some business. And also, there seems to be definitely a TINA factor that with India doing relatively well, its currency stable, having survived Brexit with dignity, so that it didn't scare anybody. A positive performance leads to further confidence in the minds of the investors. So right now it's all pretty okay, and monsoons are on track, and we hope that GST will at least get cleared. The only thing is, in the last 1 or 2 months, the market has been up a lot. But over any even 3 months period, I think it's part of life.
Volatility is the name of the game.
Right now, we like this volatility, which is upward volatility.
Let's also talk about your outlook in terms of sector allocation. Private sector banks and NBFCs is something that you've been fairly upbeat on. That's the way to go, you think?
Well, we own them because we own them for a long time. And last 2 months, they've gone up a lot, particularly the NBFCs and particularly microfinance. So to a new investor, I'll say take your time. We can enjoy and maybe trim a little bit. But for a new investor to start today, I would not be so comfortable.
Let's talk about your outlook for sectors that you would be on the watch list or the caution list right now. Do you think that perhaps some of the sectors contingent on what government policies could do would be a little bit of a caution?
No, I would think that the issue is that even if every sector is doing well, some sectors are more secular, less volatile, their market potential is higher, and they don't have to every day worry about global issues. So even if everybody is doing well, we would like these sectors. But clearly in sectors where either a global hit is very big, not hit, but positive or negative, that means global factors determine that sector. Basically, any sector which is commodity linked, where the price of the commodity is the determinant of whether your company will do well or not.
Metals, does that fall
Metals
under the
will be clearly
bracket?
there, chemicals, all these kind of things. We would not do because we don't relate to how to figure out what should be the price. Now, at some very extreme time, you may say it doesn't matter what the price is, they are so cheap. We don't think that is the case here because the debt of most of these companies is very high. So if the commodities were to correct a little, you would get a maybe 1.5 times impact on the prices here.
So many big bang IPOs, pretty phenomenal response, the likes of Quest Corp and all. Do these businesses interest you? What's
Yes.
the advice?
We liked all of them, the new ones, like whether it was the two Quest
Corp,
and
Team
Lease,
Lease.
and then before that there was the Mahanagar Gas, and before that there were those hospital ones and those whatever the chain.
Dr.
Not logistics, diagnostics chain.
Yes.
But the only issue is that we as fund managers say that if we don't get an anchor, we don't want. The reason is that in the general issue, these issues get oversubscribed 100 times and 200 times, and there is a cost for this thing. And then also you will get 1/200th of what you had applied for, even if you were to apply for more. You can't, to get $2 million, say I want to put a $400 million allocation, or to put 10 million, I have to put like $1 billion, whatever. It doesn't make sense. So practically it makes no sense. And post-market, because so far they've been going up a lot, we haven't bought after market. So my theory is, if the IPO is too good, I don't buy it because I won't get it. And if the IPO is too bad, I won't buy it because I don't like it. So basically it doesn't matter in the end.
Let's also talk about what the view is when it comes to how India stacks up versus the rest of the globe. Do you think that factors such as regulatory concerns in China could perhaps overpower some of the positive domestic triggers and positives that we have at hand?
In India, actually, even regulatory issues are in India's favor.
Right.
And economy is in favor, and current cycle is in favor. So I'm not sure what you mean by in China and with India right now from a stock market point of view. I think India has nearly all the positives compared to China.
But would some of the regulatory concerns in China pose as a dampener for us in the long run, given that we're so...
Things like whether they are attacking corruption and things like that, maybe our cars won't get sold. We don't own these companies because, as I said, we don't like globally influenced companies. Because how am I supposed to know what BMW is doing and what the Chinese policy is and whether the new model in America is doing well or not? Those kind of things basically people do because of momentum. Nobody can put down on paper that I am doing this because of this factor that I have understood. So we don't speculate.
What's the next big theme in terms of the next HDFC Bank, say?
No, right now I think the HDFC Bank is the next new HDFC Bank, because you see, if you right now look at it, the total market share of the private sector banks is about 25%, and 70 or maybe 30%, and 70% is still state owned. And the state owned guys will lose market share in the next 5 years beyond what they have lost in the last 10 years, basically because they have no capital, and secondly, they don't have the wherewithal to deal with the new technology that is taking over, whether it is app-based banking or internet-based or things like that. So, if we believe that financial tech is going to hurt banks, in India it is first going to hit state-owned banks. So the increase in market share, I think, would be higher for all these guys than it has been in the past, where in the past the entire aggregate private sector has increased their market share 1% per annum for 15 years or something. I think it could easily become 2% or 1.5%, and therefore the beneficiaries will be the same guys.
What have you made of the earnings season so far and the kind of growth that we've seen, or rather lack of it?
Earnings growth so far has been disappointing. And wherever it's been good, the reward has been very, very high, actually disproportionately high.
Unjustified?
No, not unjustified, because some of them we own, but it's a bit, okay, we can take it. We can take a positive return anytime, even if it is unjustified. But generally, yeah, the results were not as good as they could have been.
And do you think that the sluggishness in earnings will continue for some time, or?
We have, please note that year to date, only now the market is up 7-8%. And before this month, maybe it was 0. So in that sense, it's not that the market has gone up a lot, but yeah, some stocks have gone up a lot. We can handle it for some time based on the fact that monsoons will lead to earnings and that GST will lead to sentiment and that there is negative interest rates in the world, so they have no choice. All those kind of stories we can, to ourselves, not to the world, justify to ourselves that we can have this for more time. Yeah.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.